Uh, Introduction to Financial Accounting. My name is CPA Robert Magalila, and this is the introductory part. So accounting by itself is the process of recording, summarizing, and reporting a financial transaction that is pertaining to business, involving keeping track of all financial transactions within a business. Those transactions, it might involving money or any other resources, their movement that is coming in and going. The aspect in accounting is the process of keeping a running of totals or running of things. Example of item a business might keep track of include amount of cash the business currently has, now what company has paid for utilities for the month, amount of money it owes, it is income for the entire year, the total cost of all equipment it has purchased. So we now refer these revenue totals as the balances, and the things that we are keeping track of are called the classes of accounting. Financial accounting is the first class of accounting, involving a transaction that occur over a period of time during the course of the business. While the cost accounting is referred to recording, summarizing, and the reporting allocation of the cost of the process of manufacturing or manufacturing a product or provision of services. Again, management accounting is preparing management report, involving a preparation of management reports and account that provide accurately and timely financial and statistical information to managers and they make short and they help managers to make short and long term. So in accounting categories that a business keep record of, they involving one of them is asset. And this asset is anything that has current and the future values, so economic values. That this, it might be anything controlled and owned by the business with the current value or could provide a monetary value in the future. So example of this, it might be machinery, patent right, investment, physical item, intangible item, such as intellectual property. Might be cash, receivable, building stock, etc. But they must have ability to generate revenue, or they have ability to be converted into cash. And again, we have liabilities. By liabilities, we mean amount owed by a business at any time, at any one time. It is referred to as a payable. It includes everything a business owes presently and in the future. It includes loan, legal debts, or any other obligation that arise in the course of the business operations. It might be account payable, bank loan, etc. But again, we have a stockholder equity. These is maybe a remaining asset available to shareholders after all liabilities have been paid. It is what may be referred as a wealth of the owner of the business. It is calculated by taking a firm's asset minus our total liabilities. It includes a common stock, retained earning, capital, etc. The revenue, in the other end, is the money is the total amount of money generated from a normal business operations. It includes sales made during a certain period, cash or credit. Revenue is crucial because it forms the beginning of business income. Expenses are deducted from revenue to arrive to a profit or net income. So in the other way, the expenses is the cost incurred in ordinary course of the business. They include payment of suppliers, payment to suppliers, employee wages, factory lease, rent, equipment, and depreciation. And a list of accounts used by business account, categorically, they are follow the asset, liabilities, stockholders, revenue, and expenses. So, as we have said earlier, that the difference between the total revenue and the total expenses amount for a particular period, such as a month, a year, is if we assume that the revenue is higher than expenses, is where we get a profit. The reverse is a loss. So we now refer the profit as a net income. The following is the key calculation determining a business operation result. So the revenue, when we deduct expenses, is net income.